Let's see. Did that come through? Hold on. All right, Bennett. Okay. Were you able to hear my introduction of Bennet? No. All right. All right. So let's do it again. So, tonight we got the honor and the pleasure to have Bennet McDowell show us some of the techniques that he does for successful trading. Bennet was with Morgan Stanley, had managed over $100 million at one time, and now is trading for himself and other accounts. And he's got some very interesting concepts or views on how to use different scans for different patterns and risk management. So with that, I'm going to let Bennet come on and give his presentation. So.
Okay, I'm here. Can everybody hear me okay? Yes. Hello, Stephen. Thank you. Let me just make sure my audio is good. Okay, great. All right, enough yeses. That's good. Okay, as long as you can hear me. Super. First of all, it's a pleasure to be here. Stephen, thank you so much. Steve did a great webcast for us Tuesday, and we put the recording of that webcast up on our website. So if you missed it, go to the traderscoach.com website, look for a button at the top called Archive, click on that, and you'll be able to watch Steve's presentation that he did for us on Tuesday. It was a really good one, and Steve, the feedback was phenomenal from the folks at traderscoach.com that were there viewing it. So really great job. And likewise, it's a pleasure to be here. We've got a good turnout here, and we're going to talk about a couple of tools that we use, and basically we call them ART, OWL, and PTF. And ART stands for Applied Reality Trading, OWL stands for the Optimum Wave Locator, and the PTF stands for the Precision Trend Filter. And one of the unique things about the way Steve trades and I trade is we focus on price activity. You know, price is the real truth of the market. We call it the reality of the market. And basically all information about a market or an equity that you're trading is actually in the price itself. So it's very important to focus on price for that reason. And we're going to talk about that during our presentation today. We're also going to talk about risk control and a few other things that I think you'll find very, very interesting. All right, before we get started here, what we like to do on our webcast, and they're a lot of fun, is we like to start out by doing a sweepstakes. Now, I put a sweepstakes link in the announcement area, and I'm going to put it up in the text chat area too, so you have it. Go ahead and click on that link, fill out the form. What we're going to do is have a drawing at the end of this presentation for the PTF indicator. And if you don't know what that is, you will by the end of the presentation, I promise you. So get your entry in, the trading rules on any time frame. So it's something you could use as a filter, and a lot of folks are using it, and we're going to show you how it works, and I think you'll enjoy it, but you got to be in the sweepstakes to win it. So please get your entry in, and also what you want to do is get that in the next 15 minutes if you could, because we're going to start compiling those and pick the winner. Now, you have to be present at the end of the presentation in order to win. So if you sign up and leave and we call your name, you're not going to win. We're going to move on to somebody else. So you got to stay for the presentation in order to actually pick up your prize. So that's very important. All right, like any presentation or webinar, I always like to start out with a brief disclaimer on risk. There is risk in trading, but of course, without risk, there's what? No opportunity. So the two really go hand in hand. But, you know, we have to mention it because it's important, especially if you're new in the business, to understand the risks involved in trading. The other thing I like to talk about before I get into the material is really how trading, I think, is the perfect business. Mainly because how many retail businesses out there have had a hard time during the recession in the late in the last 5 years, how many have gone out of business. With trading, we can actually have the opportunity to make money by shorting the market. So whether the economy is strong or poor, there is always opportunity to make money in trading. And of course, with the technology today and the software today, you can do it practically anywhere in the world you want to. You can do it from your home, an office, and you couldn't do that 20 or 30 years ago. So the technology today has really put it in a league of its own. And you don't have to hire people either. So if you're worried about having an increase in medical costs for your employees this year, technically you really don't need any employees. It's you and the markets. So it's a pretty cool business that way. But you got to have the right tools. And this is where things like candlesticks, some of the things we're going to show you today, risk control, you owe it to yourself to find the tools that fit your personality and your philosophy on trading. So today I'm going to talk about 3 specific types of tools. One is we're going to talk about the ART trading software, and ART stands for Applied Reality Trading. And I'm going to show you how we have a scanner that actually scans the universe of stocks, and it's called the ART scanner. We're going to talk about the Allen PTF indicators. We're going to talk about some compatible charting platforms, and we're going to talk about some money management software that we have called the Trader's Assistant and the Trade Size Calculator. So we got a lot of information to cover. And I also want to just make a note here as well that you may have questions on the material. Go ahead and ask them. I may not answer them right away, but I'll probably take a little break from time to time where I can get to some of the questions and answer them for you. All right, so I see a lot of questions. I was watching some of the questions coming in before I started here, and one of them was, does our software work on? And so this slide here answers that question. Obviously, you can see eSignal, TradeStation, NinjaTrader, Trade Navigator, Multicharts, MetaTrader 4 and 5, Market Analyst, and we're always adding new platforms. So basically, we update you on that. Now, through the use of these platforms, they have the ability to connect to a lot of different brokers and data providers. For example, NinjaTrader out there, that can connect to Interactive Brokers. It can connect to eSignal, Zenfire. So one platform can have the ability to connect to different brokers and data dealers. So the idea is you may think a platform is not compatible, but it may really be because it has the ability to connect to a variety of different data providers. Multicharts connects to Bloomberg, et cetera, et cetera. So anyway, all this stuff we can go over again if you want to, but it's pretty compatible and a lot of different features are available. Now, I've written 3 books, okay? Steve gave me a little introduction. My first book is a trader's money management system. This book is specifically on risk control, published by Wiley, available at Amazon and all the bookstores. And it's a great book. I took a lot of complex portfolio theory, put it into a basic format for those of you, regardless of your experience level, can focus on risk control and apply it right away. Risk control can be a very complicated topic, but the concepts in this book can be applied right away. The Art of Trading, the book in the middle, that's our book on how to use the ART trading system. And the Survival Guide for Traders is a book that I've recently written that talks about utility. We also run how to manage your business like a hedge fund in there, and I give you a great business plan in there that you can use as well. So those 3 books are available at a lot of bookstores. I got a new one coming out in the fall, the winter, on Elliott wave analysis. I'm big into the Elliott waves. So that's an area that I like. So I'm doing a book with McGraw-Hill on the Elliott wave. All right, let's talk first a little bit about the ART software and see what makes it tick. When I designed the ART software, basically what I was trying to do is put structure into my trading. This was my own trading. Now, as Steve said, I started back on Wall Street in 1984. I worked for J.J. Kinney in the Municipal Bond Department. and eventually went on to Morgan Stanley Prudential Securities, managed some money for high net worth individuals, and developed a trading approach, okay, for those individuals that was actively traded. And we traded everything, stocks, intraday traded the S&P 500 and so forth. And the key on developing a trading approach for me was that I needed structure. I needed to have a game plan. And I think most traders out there, when they first start trading, they really lack a game plan. They kind of pick up a couple books, they read a little bit here and there, they pick up some tidbits just to be dangerous, so to speak. But they need to know how to put it all together. So when I developed the ART system, my goal was to make it comprehensive so that basically it not only gives you a system with a set of tools to spot high probability entries and exits, but also gives you a structure, a game plan in order to be flexible enough, get enough structure so you can modify it to your trading approach. And I'm going to show you how that works, okay? So the ART system really is, when you think of the ART system, I want you to think of a system that has tremendous structure and also quite a few moving parts in it. Let's take a look at some of these moving parts. First thing we want to do is when you have so many markets out there, and I got to tell you, they're adding more and more markets all the time. You have 9,000 stocks. You have bond markets. All right. You have the ETF markets. Okay. You used to not have ETFs a long time ago. Now you have ETFs. Huge market in itself. Forex. And I can go on and on and on. Then they started taking the futures and adding all the E-minis to the futures. So the next question with all these markets, how do you find the right one to trade? Well, you have to, again, have some capability to scan or search markets for the types of setups that you like to trade. All right? And so we developed the ART scanner to help us with that. And I'm going to show you a little bit about how that works later. The ART trading software we use for our entries and exits. And then, of course, you have to have money management. All right? A trading system is no good unless it has money management. I have seen folks literally start out with a trading approach, and they're only right about 55% of the time because they're new, but because they have such good money management, they're able to actually turn a profit. In other words, their payoff ratio is 2 to 1. And better than 1 to 1 on a 50-50 system will make you a profit. So actually you can do pretty well on just being right half the time if you have really good money management. With a good trading approach, okay, you're probably going to be right maybe 65% of the time. And that's good. All right? You might see some ads in the paper where people say, well, you're going to be right 80% of the time, 90% of the time. All right? Probably not consistently. I think over time, if you're right 60 or 65% of the time and have really good money management, then you're going to do really well in this business. All right, psychology. You have to have the right psychology. You can't be sucked in or lured into the market on the latest whim, or you can't be subject to fear and greed. So you have to have these components, okay, all synced up and working together like this chart of the gears. I love this chart because it really kind of shows how they mesh together. And I think it's pretty safe to say that to be a successful trader, you have to be good in all these areas, okay? So that's important. All right, now I want to talk a little bit about the ART system. And I see people are saying, hey, can we get to some charts? We're going to get to some in just a bit. All right. Now, the ART system consists of 3 studies primarily: pyramid trading points, ART reversals, and ART color bars. The pyramid trading points have 2 types, a dominant called a P and an MP, and I'll show you what those look like. You'll see some 1B and 2Bs on the chart. And you'll see bullish, bearish, and neutrals on some charts. All right. The pyramids we use for basically trend trading. And they're basically looking for 1, 2, 3 patterns. Okay, let me just see. I'm seeing no slides, no slides. Is everybody seeing the slides okay? Some people are not seeing the slides, so I want to make sure I don't continue. Slides are good. Okay, yes, good here, good here. Okay, good. All right, I guess if you're having trouble with the slides on your end, maybe log out and log back in might correct the situation for you. All right, so really quickly, I want to go over pyramids here and what they mean. Basically, some people call the 1, 2, 3 patterns hooks, okay? The pyramids also look at momentum as well. We're going to take a look to see exactly what they kind of look like when they're drawn on the chart. When I show you charts, you're going to see these triangular pyramid triangles drawn. And basically what they're doing is they're capturing the first leg up of a 1, 2, 3 pattern called the apex, and then capturing the support area, a base leg. And then when prices breach the apex, that's when the trade is entered. And if you think about the definition of a trend, especially an uptrend, it's higher highs and higher lows. All right? When we have a bearish market, they point in the other direction. Now, the ART software doesn't just label every 1, 2, 3 pattern it sees. It's also looking at momentum in the market. And that's how fast price is moving over time. Very important. We do not look for volume when we form a pyramid trading point. And the reason being, okay, is because volume usually doesn't kick into a trend until what? Until the herd realizes the trend is in place. So a lot of trends begin or break out on actually fairly moderate volume, sometimes even low volume. But they can break out on good momentum. And Steve covered this on Tuesday when he was talking about the fact that you can have a trend start to move on low volume because everybody, for example, in an uptrend is buying and there's no sellers. Doesn't mean the volume's high, just means there's a lot of buyers at that point, okay? So trends can begin on low volume, okay? In an uptrending market, here are these, no market just goes up like a straight line. They zigzag. They have resistance and support levels. These support levels and resistance levels, okay, are areas where these pyramids can form and they're classic 1, 2, 3 patterns. Now, the second study is called the ART reversal bars. And what we're looking at here, okay, is 2 types. And basically what they're doing is identifying key pivot points in the market. Hammers, dojis, and things like that for candlestick traders, very similar, okay? And for a signal bar to be produced, we need to have a close, okay, above the 50% mark. 50% mark is the distance between the high and the low. So we need to have a bullish bar on that. We have 2 types. We also have a 2B reversal, where the first price bar is used for the stop loss, and the second price bar is used for the trade entry. So we'll look at more of these as we go along in some other charts here. The third study is called the ART color bars, and basically this is how we determine whether a price bar is bullish, bearish, or neutral. If it's bullish, again, what we care about is how prices close in relation to the length of the price bar. One of the unique aspects of the ART system is that you can mix and match signals. And so let me show you what I mean by that. All right, if we take a look at this chart, notice that based on what you know on pyramid trading points, we have our first entry over here on the right. And so that's going to be in this area here. Then prices move up, and we actually get a signal in the opposite direction of the trend. Now, if you're a trend trader, okay, obviously you don't want to be leaving the trend. You want to stay with the trend as long as possible. But the ART system is going to give you some options that you can decide to use or not to use, and it's going to be based a lot on your psychology of fear and greed. And also that fear and greed is going to be represented in your trading rules. Now, when I talk about trading rules, basically how we mix and match trading signals is basically a symptom, basically, of your trading rules, of what you've tested and what works over time. So trading rules need to be tested. You can't just jump into the market without some form of testing because you want to make sure that your trading rules are valid. And so depending on what your trading rules state, okay, there may be times when you want to scale out of a trend but not leave it entirely. And so in a situation like that, if you enter here, all right, we give you an option to scale out here, but you're technically not allowed to leave the trend until prices eventually break below one of the pyramid trading points, flat part of the triangle called the base leg, because that represents a key level of support. So in this trade here, you would have entered here. Your initial stop would be under the first pyramid on the far left-hand side. As markets move up, you get this 1B reversal here that I've highlighted with the elliptical. And if prices go below it, you could have scaled out, but you could have done nothing as well. So that's a decision that could have been built into your trading rules or not. Prices continue up, and we get our next pyramid, and here's where we move our stop from here now up under to the new pyramid. So we give you some options, but again, we want you to test the options to see which ones are best for you. Now, on this chart here, notice on the far left-hand side here, the market breaks to the upside. We have a hyperbolic move, sideways movement, another pyramid forming here, another one here, and then finally stopped out over here when the prices go below the most recent pyramid before the sell-off. Then prices recover, and back up we go. If we take a look or isolate or magnify this part of the trend, okay, there are some discretionary decisions you as a trader could make. And what we recommend to do is when we say make, in other words, what we're saying is that you could scale out of a trend. We don't want you to leave the trend, but there's times when it may make sense based on your trading approach to scale out. For example, really quickly, in your favor in a very short period of time, and your profit is moved up already 10%. That, based on your trading rules, could qualify you to scale out. Now, if you're a new trader, okay, and you start to get really anxious or have a fearful mindset, then you may want to start scaling out a little bit sooner than that, because the idea is we don't want so much anxiety to hit you that you become an emotional trader. So, unfortunately, anxiety has to be taken into consideration, and everybody's a little bit different with that. So what we're saying is we'd rather have you scale out a little bit, relieve that anxiety, and stay with the trend. Versus what usually happens, people get so anxious that they just pull the trigger and get out of the trend. And why do they do that? Why do you think people so much of the time get anxious like that? Anybody out there? Fear. Amen. Okay? Losing money. Exactly. So, and also too, you know what they do? A lot of people, especially when they're new in the business, they haven't tested their system. So they don't know what consistency really is in their trading approach. So what happens is they're always trading what? Their last trade. And so they tend to bounce around like a ping pong ball. And so this is where a set of tested trading rules will give you that structure so you're not doing that. All right? So let me go on to another slide here because I just want to show you on this slide here, and let's give this a second to load, that this is a magnification of that squared area from the previous chart. And all these down areas are areas that the ART software has created as possible areas to scale out only. Options to scale out on bearish signals in the opposite direction of the trend. Now, the green pyramids with the label of P under them stand for primary trend. So the trend is up. The red-colored triangular pyramids have an MP above them. And the MP stands for minor pyramids and are representing only a correction in the dominant trend up. So anytime you get a MP or a 1B or 2B that's red in color against a bullish green trend, these are all areas that are possible scaling out areas. We only recommend scaling out a maximum of 2 times on any trend, okay? But again, the purpose of scaling out, to lock some profits in, okay, market conditions can change, and so what we're trying to do is give you some structure so you can handle the markets as they're unfolding in real time. I want to talk a little bit about stops, okay? The stops are very important to talk about. All right, 2 types of stops that we recommend using is the initial stop, and basically with the initial stop, what we want to do with that is when we enter the markets in place. As the market moves in your favor, all right, have a methodology for trailing the stops. And that's called a trailing stop. So basically never trade without a trailing stop and an initial stop. On this slide here, on the far left-hand side, okay, basically here, our first entry, okay, is on the far left-hand side when prices go above the point or apex of the pyramid. The stop loss is set 1 tick below the base leg of the pyramid. And these pyramids are not magic, okay? What they're doing is they're giving you a quick icon formed by a 1, 2, 3 pattern based on momentum. Okay, and so they're just there so you can easily see where your stop is, okay, and where your entry is, okay. The thing that separates this from a common breakout system is the fact that the pyramids are analyzing the momentum that's forming these patterns. And so not every 1, 2, 3 pattern is going to be labeled as a pyramid. So that's the difference between this and a normal breakout system. The pyramids do a great job of taking a look at the momentum to find the best levels of resistance to form apexes and the best levels of support. And so then as the market moves up, what they do is they create new pyramids when necessary, and the trailing stops move up. So in this trend here, all right, you would not have gotten stopped out until prices broke below the pyramid on the upper right-hand side. Now, this area in here, when it went slightly sideways, okay, produced some areas where you could have scaled out if you wanted to. All right, now, when I first started trading, I used to use moving averages primarily as my stop loss points. And I got to tell you, they didn't work too well. And I became pretty frustrated with them because what would happen is I would be taken out of perfectly good trends way too soon. What exactly I'm talking about here. Here's a chart with a very liberal 50-day moving average. Notice prices dip below this moving average, and this is the same market we've been looking at twice. All right? Now, most people that use moving averages, when prices close below the actual average, that's when they get out. Some people actually, as soon as they dip below the moving average, they get out. But the idea is when they go below the moving, and here is a 50-day moving average with the ART system reapplied. And here is the ART system with a 30-day moving average. Now, a 30-day moving average, we're getting up to more of the normality of what a swing trader would use in trading the markets. The 50-day moving average is pretty liberal. All right, that's kind of right on the basis of what a longer-term trader would use. But the 30-day is getting close. This area here, the price has penetrated the line 4 times. So the idea is you would have been stopped out 4 times here, and then you got to get back in. That's a little difficult. Here is a 20-day moving average, and it created 6 points that got stopped out. So this is what I was experiencing way back when I began my trading. And I scrapped the moving average system. It just, for me, it didn't work. What I found better was to use key levels of support in a trend and use those as our stops. Okay? We aren't recreating the wheel here. Okay? This is not complex stuff. It's kind of like, are not complex, but they're very good. If you keep it simple, stupid, all right, you'll do a lot better in the markets than overcomplicating it. Okay? All right, so basically, this is why I found using key levels of support worked extremely good for trailing stops. Now I'm going to talk a little bit about some indicators that we added into the system in order to help us see kind of the roadmap of the market. We use these more for forecasting. So now we're going from a component of focusing on the realities of price structure to actually looking at forecasting methods. All forecasting methods we call as ungrounded assessments. What does that mean? It means that they're theory, they're fantasies. Trading price activity, like you guys do with candlesticks and like what we do with the art system, that is called grounded approach. And the reason is because you're basing your entries, your exits, and your structure off the actual price activity. But there is a place for forecasting, provided you keep that in mind. So what we do is the OWL indicator is an indicator that draws a histogram, and you apply it at the bottom of the chart just like you would any indicator. And basically we use it in Elliott wave analysis, all right? And it takes a lot of the subjectivity out of the Elliott wave analysis. When we have an indicator, all right, that is peaking, and it makes sense with price structure, that is an indication of a wave 3. When the indicator goes negative after the wave 3, that is wave 4, which is a wave 4 correction. Now in Elliott wave, all trends consist of 5 waves. Waves 1, 3, and 5 are impulsive and all go in the direction of the trend. Waves 2 and 4 are corrective. Wave 5, which makes a new high like on this chart here, always has bearish divergence in the OWL histogram in relation to wave 3. This is how we know we're getting to a top of a trend. The OWL histogram is not an MACD. Okay, this is a finely tweaked histogram that we have tested that works extremely well with Elliott wave analysis. So if you're into Elliott wave, this is something that really can help you tell the difference between a wave 3 and a wave 5, and also help you identify when you have a wave 4. We also have something else called a PTF indicator. Now the PTF indicator, this is what we're actually going to be giving away today. The PTF indicator is a really fun indicator, very easy to use. Basically, when you have a green colored background, you just find the highest price bar, because that's a bullish signal. You find the highest high, and I've circled a couple, and it means that there's a 75% probability that prices will return and take out that high. Now you might get a correction from that, but it's not a change in trend. Eventually when the correction ends, you should go above that particular price bar 75% of the time. Likewise, if it's red, it means you have a 75% probability, okay, that low, okay, will be penetrated again. So why is that helpful? Well, because basically if you have a red PTF, then it's not an indication that the trend is over. And so you've got to be careful going long, okay? All right, now I want to quickly move over to money management. We have 2 pieces of software that we use and rely on a great deal. One is called the Trader's Assistant. The other one's called the Trade Size Calculator. The Trader's Assistant has a lot of calculations built into it based on portfolio, deliver the percent that should be risked on each trade based on the trader's closed trading performance. So you take closed trades and it calculates exactly the amount that you should use as a risk amount. That risk amount then is transferred over to the trade size calculator, where we use it to calculate, okay, our trade size on each and every trade. Let me show you some examples. All right, so here's an entry on the trade size calculator. This happens to be the S&P E-mini contract. We put an account size of $50,000. We put a 2% risk in, an entry price, an exit price, and then we fill in the commissions. They can be estimated, and then you got to calibrate the calculator to the futures market. So 1 point on the S&P E-mini is $50. So you put that in there, and you put the margin in. You hit calculate, and the idea is it shows you that your trade risk should not exceed 4 contracts on this trade based on a risk of 4 points and a $50,000 account. And so here are some of the variables and how it's put in there. Okay, here is the risk is higher. Okay, it's $5.75. So the key to remember here is that we're keeping the risk a constant. The percent risk is 2% always. What changes in order to keep that risk at a 2% is your trade size. So if the distance between your entry and your exit is far apart, the trade size will go down in order to keep the risk a constant 2%. This way, if you have a trading system that has a win-to-loss ratio of 60%, meaning that you're winning 6 times and losing 4, all right, and your payoff ratio is 2 to 1, as calculated by the trader's assistant, then that's going to yield a percent risk you should use as 2%. And so therefore, it means that of every 10 trades, when you lose 4, you're going to be losing what? No more than 8%. And out of the 6 that are winning, if you have a 2 to 1 trade size, you're going to do great. All right, so I'm going to move along a little bit because we got a lot to cover. All right, here is calculating trade size for a stock, for example. All right, basically your short trade entry can be 1634 on this example. The exit 1686. The risk is 0.47. All right, so this is actually 2 questions. First question is, what is the maximum trade size for this trade if the account value is $50,000? Percent to risk is 2%. Commission is $10, and it's a margin account. Well, you put those figures in the calculator, and then the second question is, how much did this trade cost in terms of buying power needed for maximum trade size entry? On the next slide, basically, we'll show you a close-up of entering all these numbers in from that previous one. And so it produces a 2,106 trade size based on the entry and the exit. Your dollar risk is $1,000. So what that means is that if this trade fails and loses, then you're going to lose $999.82. That's what's 2% of 50,000, which is your account size, $1,000. So you're within that 2%. It keeps you within that 2% margin. Then to calculate how much it's going to cost in terms of buying power, well, then you take 2,106 shares and just simply multiply it by the entry price of $16.39, and so it's going to use $34,517.34. So that's your buying power. So on the next trade, you got to reduce the account size by $34,517.34 in order to get, you don't exceed the account size and risk. Here's an example of some trading we did back on one of the markets here. And this is this market we've been looking at the whole time. And actually, one of the things I want to show here is that our first initial entry was on point A on the left-hand side of the chart. And that was trade number 1. And we used the trade size calculator on the upper left-hand side to give us our trade size. We went into the market. We then moved our stop. Our trailing stop then got moved up in September up to a new level. And let me ask you a question. What now happened to the trade risk on the first trade? Anybody out there? Now we're talking about trade risk now, not market risk. What happened to the trade risk on the first trade? If our new stop was trailed up to that pyramid in the middle. And I'll circle it, but my arrow's not that big, so I don't know if you can see it. Break even, okay. Anybody else? Down, okay. All right, the trade risk actually on the first trade is gone, all right, because now the new stop loss area, if that's hit, you'll make a profit on the first trade, right? Okay? So what does that allow us to do? It allows us actually to go back into the markets with another 2% of trade risk, doesn't it? So on this pyramid here, we calculate again the proper amount of contracts, okay, and that's 478 shares on the second entry, okay, and so now when we're entered in on this price bar here, where the arrow is, now we've got not only 846 shares from the initial entry, but we've just added on 478 shares, but our trade risk is still just 2%. This is the proper way when momentum trading to add on to a trade. What you don't want to do is add on to a momentum trade when your trade risk, okay, is still on from the first trade. You don't want to increase your trade risk past 2% based on what's in the calculator. Now, some of you may be a real great traders. You may have a trade risk of 4%, all right, depending on what the trader assistant and the risk of ruin tables tell you. But for this example, we're using 2%, and so that's the idea. So here's an example of how to pyramid into a trade safely while maintaining a 2% risk. So if this trade failed and your trade was stopped out, well, you'd make a profit on the first trade and you'd lose on the second trade. Unless you had a new trailing stop, which eventually happened, okay, and prices moved up. So that's just a little quick example, okay, of money management. All right. The other thing that I wanted to cover here quickly, and I want to move here pretty quick, is scanning for markets. We use the ART scanner, works in TradeStation, NinjaTrader, Multitarts, to identify when these pyramids show up. We also scan for bracketed markets. Big trends come from bracketed markets. We have a complete proprietary scan for these built into the ART scanner. All right. So basically, you want to stay out of these consolidated areas and wait for the alert you to that. Here's a couple quick examples of the Trader's Assistant PC software. This is an example of, we formatted this as if you were trading right on the floor. And the idea is you have trade posting cards where you fill out information on the trade. It has ledgers of what you have active, what you have open and closed. All right, it has complete statistics. But the real kicker is this, okay? This is basically the risk of ruin calculator that will deliver the percent risk based on the risk of ruin calculations built into this. And this is what you would use in terms of the percent risk to put into the calculator. All right? Now, one wrap up here is we've covered a couple things. We've covered the OWL. We've covered Elliott Wave. We've covered ART. We've covered money management. There's a couple other things we look at in tying it all together, okay? We use the ART system to control our entries and exits and risk. We use the OWL and PTF to help us distinguish between corrections and a change of trend based off the Elliott Wave, all right? We can use it in downtrends or uptrends. This is an example of, notice the pink dot on the histogram indicating a wave 3 in progress. We have a red PTF here, so we have more lows coming. So the idea is happens to be Apple when it topped. We were looking for a change in trend. We used Fibonacci retracements, extensions. You can see a clear ABC correction from the April high on Apple right down to the May low. And we were expecting wave 5. We got it. It reached the target zone. Change in trend was expected. We got it. We had bearish divergence between wave 5 and wave 3. We had a new pink dot on the lower histogram and a red PTF, change in trend confirmed, support levels on wave 5. That's called connecting the dots. All right? Here's a situation we're breaking into new highs here, okay, on this particular market. This happened to be an ES on the 15-minute time frame. All right, basically here, wave 3, wave 5. Okay? And here's a wave 3 in progress on the Forex market. Here's another example of what stops in place. Okay? And here's an example of using a Fibonacci extension after wave 5. 4 was identified. Wave 4 has to have a negative owl. We had it. It retraced properly, and then we could draw our extensions. All right? So the purpose of that is not to show you, hey, you know, this works great, and so forth and so on. The purpose of that is the importance of knowing how to connect the dots on whatever trading approach or set of rules you have and become really good at it. Now, what we do, okay, is we also have a subscription service where we actually apply exactly what you just saw and pick out 10 markets that are going to be the best markets for that week based on our analysis. We choose 4 stocks, 2 futures, 2 ETFs, and 2 Forex markets. And so I'm going to put a link up because we got a special that we're going to do for this webcast where you can save 50% on the monthly subscription. So let me put up the link for that. Give me a second. And this is not an expensive service. It's $24.98 a month. We have a ton of subscribers, and there you have it. We have results on that page so you can take a look, okay? So check that out, and if you're interested in that, you can bookmark that and come back to it at another time. All right, now, I want to move on. One more thing to hit. And in terms of money management and risk control, you've heard this 1,000 times, okay? Keep your losing trades small and let your winning trades run. You can only do that if you use risk control. All right, you ready for the sweepstakes? All right, let me see, we got yes, okay, we get a yes. Okay, great. Okay, well let's take a look at a couple sweepstakes here. We've got about 10 minutes left. So I'm going to announce a winner of markets, and then we'll come back and wrap it up, okay? All right, so let's see. Drum roll, please. We got a lot of people that entered the sweepstakes, which is great. So we give us a second because we like to make this totally random. I think, you know what we're going to do? I think because we have so many people here, should I do 2? Thank you, Harry. Good drum roll. 2? Should I do 2? Okay, 2. We'll do 2 winners. How's that? All right, so let's see what we got here. Stand by. All right. Are you ready? I got one. You ready? All right, Bob Walker. Bob Walker, are you there? You got to be here to win it, so you have to respond. Bob Walker. Hopefully there's not 2 Bob Walkers, but Bob Walker. I don't see Bob Walker. Going once. Going twice. Is there a Bob Walker? Where's Bob? He walked away. That's a good one. LM, that's a very good one. I like that one. He walked away. Okay. All right. So let's go to somebody else. All right. Stand by. I got to shuffle these again. All right. Terry Turner. Are you out there? Terry Turner. Terry Turner. Don't tell me she's left too. Terry Turner. Is she out there? She's gone to get Bob Walker. That's a good one. All right. There he is with Bob. Okay. Well, you know what? We got to move on. Boy, they missed out. You know Terry Turner and Bob Walker. You got to have to tell them. All right. Let's see who else we got here. All right. How about, all right, here's another one. You ready? Okay, here we go. Ed Smith. Ed Smith. Oh, Bob Walker is here. Okay, Bob, congratulations. We thought we missed you there. Okay, so Bob, I'll explain to you what we're going to do here. Let's see if Ed's here. We're going to announce two winners here. Ed Smith, excellent. Okay, good. All right, well, you guys are our winners, okay? All right, so here's what's going to happen, okay? We're going to email you a download link for this software called the PTF Indicator, which we covered. There's complete instructions on how to use it. This also qualifies you for our Wednesday software support sessions. I hold these every Wednesday with our users. And you come, and if you have any questions or want me to show you some things on how it works, we can do that, okay, at that particular point. All right, let me, I'm going to just escape here for a minute, the PowerPoint. I'm going to bring it back up. All right, I want to just go over a couple things. One is on live markets. Here is the Australian-Japanese Forex market on a tear, and this has been just doing phenomenal. This is one of our, Forex picks on our stock picking service. And basically, it's in a wave 3. We've got a stop set here, and it's just trucking right along. This is on the TradeStation platform. You can see here, down here, I've got the scanner. I've also got the 60-minute chart up on the S&P E-mini. One of the things we had wave 3 on the left-hand side. It's moved over to here because it identified wave 3 inside wave 5. We're starting to see bearish divergence, and we had a little bit of a break, okay, in the 60-minute time frame. So it'll be interesting to see if we take out this resistance level that formed today over the next couple of days, or it heads higher. We do have a negative owl here, so we're expecting some form of sell-off in the S&P E-mini. It may have started, but we'll certainly see here, okay? All right, let's see what we got. I got a lot of blinking tabs here. It looks to me like we don't have... Can everybody see my screen? Because I'm only showing, I'm only seeing one, I'm not seeing any charts up there. Yeah, I don't see that. Okay, hold on a second. See what's going on here. Let's redo this. Don't you love technology? Okay, there it is. Okay, that's the S&P E-mini. Okay, now you should be able to see it. Okay? All right, I'm going to start over. All right, so this is the S&P E-mini, 60-minute time frame. I'm going to wrap it up. We're coming pretty much to the end. I got just another couple minutes, but I just want to go over a few live charts because it's always fun to see live charts. This is the S&P E-mini, 60-minute time frame. All right, we've been watching this because we expect some type of reversal in the overall market pretty soon because we've had like 15 consecutive days, except for today, where it's done nothing but go up. So we're kind of due. So we'll drop down. We drop down to the 60-minute time frame to take a look. Notice we have bearish divergence building in the owl. We have a yellow PTF, so it's not green anymore. Okay. We've got prices kind of meandering to the upside, topped out right about here. Okay, on the 29th, and then pulled back a little bit. And so we got a negative owl here. So it looks to us like we're getting in an area where the market's about to crack. Let's take a look at the overall Dow. Okay, and see how that's doing. All right, notice here we're starting to see a pullback. Look at this hyperbolic move. So if you put some fib retracement levels up, we'll probably come down to 13,500 or so. We still got a green PTF, so we're going to get more highs on this. So you got to pay attention, but we're due for a correction. Okay. Another thing I want to take a look, and I'll switch to the eSignal platform. This is Facebook. All right, a lot of people are said buy Facebook. A lot of the brokerages, but I'm saying not to. It looks to us like we had a wave 3 down here. We've had a wave 4 correction here. Notice prices just dip below this pyramid here. I wouldn't have traded this wave 4 correction because it's just that, a correction. It has ended in the Fibonacci retracement area of 0.382 to 0.618. So I want to see how this unfolds a little bit before getting excited. I think it's actually going to have one more major dip down before we start to see a buying opportunity. So a little too soon for buying into Facebook, okay? Netflix is another one that we've been watching and actually watched for quite some time. This is one that has really reached a nice bottom, and you can see this was a sharp move down here in September on the far left-hand side. ABC correction, wave 4, wave 5 ended. This is a very, very good change in trend, bullish run. We're getting a wave 3 on the owl with a green TTF. All signals are up. You will get some form of correction, but the trend has reversed from the downside to the up. REM is the last one I'm going to look at, and then I'm going to have to go pretty soon because I don't want to overstay my welcome here. But in any case, with REM, we had a key level of support on this price bar here, okay? On the trend down, we broke above that. We also had a smaller level of support down here, okay? And we broke above that. We had a major 3 and then a long 5 ended here. This is another one that's moving up. We're seeing a significant pullback, but we think we're going to get more highs. You still have a green TTF. So that's just a few charts on some live markets. I like to do that because I think it's kind of fun to let you see how the software works on live markets. Okay, so I'm switching back to the PowerPoint, and I think we're finally at the end, aren't we? All right, so this is where I get to say thank you for attending, okay? I hope I didn't go too fast, okay? There was just so much material I wanted to cover. I wanted to touch a little bit on each of the aspects that I think is important, okay? Like I said, we have a ton of people that are using art and candlesticks together, okay? So this is an approach where you can add it together. And actually, like Steve said in the beginning, you know, if you find another edge or a tool that helps you, that's a good thing. What also you could do is the indicators are super great for helping you notice when a trend has changed or if there's more room still left in the trend. So that might be another thing that you might want to add in as well. Also, too, don't forget, we have the stock picking service, which is also in ETFs, futures, and Forex. And that is very, very reasonably priced, and we've done that on purpose. Again, we got tons of subscribers. We really want to build that up to a really great service. It's on its way. So we wanted to make that an offer that's available to you as well for this webcast, okay? So I hope everybody got something out of it, because that's always the most important thing in doing these. If you have any questions, here's our contact information, okay? I think probably Steve is recording it, so the recording will probably be available if you want to re-see it. But finally, I want to say thank you so very, very much, okay, for having me. You guys were great. I don't know if I got to too many questions simply because, my gosh, there were so many people here and the questions came so fast. It was hard to stop and really see, okay? But in any case, you can always email me any questions at the email address on this slide here. So I think with that, Steve, I'm going to turn it back over to you. Again, I want to thank you for having me and introducing me to your group, and I wish you all the very, very best and trade well, and main thing is have fun too. See you next time.
Bennet, thank you very much. Very informational. And again, everybody, this is stuff that you want to take a look at. Anything that you can add to your own mental computations and fit into your trading style, it's just that much better. If you can find all the right pieces that work for you, that's what makes a successful trader, is knowing what to do on your own and not have to have somebody else give you instructions on how to do a trade. So, Bennet, thank you very much. And thank you, everybody, for coming tonight. We'll see you all in the chat rooms.